it any differently, or does the strategy change for you simply on valuations?
So for us, the methodology is fairly robust. That means we won't be changing it. And so the fact that we had a great bull market in 2013, the fact that tech has had a fantastic year relative to other industry, it doesn't mean we're going to go back and redo the methodology to sort of trend chase. And so largely it's going to be the same methodology that's focused on anchoring to fundamental and therefore anchoring to valuation.
How does your methodology work with some of these new technology or internet-based stocks where you're not seeing the sort of revenue or profits and they're high flyers? Can you even include stocks like that?
So the methodology generally tends to stay away or underweight these high flyers that have tremendous positive market momentum but very little in ways of fundamentals to show for. Now, it's not to say they're not going to be fantastic companies. What it says is, on average, the market tends to get too excited, tends to overpay for these companies, and you, on average, do better by staying away from them.
Is there any tech company, for instance, that meets your methodology, that, whether it's a Google or some of these other stocks that do have a little bit more staying power, I guess?
Absolutely. If you look at Apple, it was obviously a big underweight when it was on its way to $1,000 because the price momentum was very strong, but the fundamental was just sort of catching up. But of course, after the decline, when it retreated back toward $400, now there's very negative market sentiment. In fact, it's fallen by nearly 50% in terms of its weight in investors' portfolio. That's the time when we started to buy. Fundamental is still relatively strong, as is the case for Apple, but price sentiment has become quite negative. So we tend to be contrarian, and it means we're going to be buying good tech companies when price falls and you're able to buy at a discount.